And for a closer look, we're joined by Francis Tan, Chief Strategist, Asia Indus Wealth Management. Francis, thanks for joining us today. So the key activity figures out of China for August is expected in a short while from now. The three key ones, retail, industrial, as well as fixed asset. And the expectation is for little improvement. Your thoughts on that? Is that your base case as well? And one key point I wanted to note is that the July figure was weak, and that was blamed on bad weather. So how significant will this be in this latest set of data?
Well, I believe there will be a continuation of the previous month of data as we're seeing. There seems to be a divide right now between the consumption sector in China and also the industrial sector in China. Now, from that, what I'm seeing is a little bit of a trend right now that the industrial sector, which is manufacturing, is still very much exposed to the uncertainties surrounding the US-China trade talks, the tariff, the impending tariffs that's going to come up, and in terms of which sectors will be hit more or less. So that sector, the industry sector, which in China we call it the secondary sector, the manufacturing, is going to come on still as quite weak. However, very interesting fact right now is that I'm seeing a positive trend in the consumption sector, which has been down for a couple of years, mainly due to the decline in real estate prices, and that was driving a negative wealth effect into households of China. But guess what? Recently, I do see a bottoming up process in the real estate sector, and in fact, very interestingly, the year-to-date strong rise in Chinese equities is also creating a positive wealth effect for households. So in that sense, I'm expecting a better retail sales number or improving trend in retail sales that will justify the consumption story in China. However, on the other hand, the production story may be a bit slower. Also, another thing is because of the anti-involution campaign from the policymakers. I think that will also slow the industrial production a little bit more.
Yeah, so how should investors be interpreting this sort of mixed signals that the market's sending, rebounding consumption, but persistent weakness in production and investment? Do you see it as a chance to adjust their portfolio or, keep it as it is?
Certainly. So right now, if we look at the two main engines of growth right now, which is the consumption sector and also the industrial sector, I would say that investors can do a minor tweak in their portfolio allocation, slightly away from the industry sector, because that is still marred by what we are thinking of uncertainties in the months ahead. But however, with a nicer trend right now there's going to be in the retail sales, or even in consumption demand. I was looking at some high-frequency indicators of how China's box offices, the traffic flows. So things like this are also supporting a better consumption story. So investors can do a little bit better by shifting away from some of the industry names in the sectors and putting them into consumer discretionary or even consumer staples. At the end of the day, Chinese manufacturers manufacture goods for domestic and for export, but for the domestic consumption, it's mainly the goods sector and also the services sector. So if we are thinking that the retail sales or consumption is going to be better going into 2026, which is very near, right? I think another segment to look at is also consumer services sector.
And, given the sort of mixed picture we're expecting to see, are you expecting further policy easing, and how might markets react if the stimulus underwhelms?
Well, I believe right now, if we're looking at onshore central bank policies, I think there's going to be a status quo. I do not think right now that the PBOC will be in an urgent need to cut interest rates further. Although inflation in China is hovering around zero, but producers' price index has been seeing deflation for many, many months already. But I don't think there is still an urgency to cut to support growth, because at the end of the day, if we look at the consumption as a percentage of GDP, that's quite a large portion as well. And since as I was mentioning just now, consumption is doing a little bit better going into the end of 2025, so PBOC could be also saving or reserving the ammunition of dovishness if the trade talks between China and US doesn't go as well. At least PBOC has some bullets maybe to cut rates further. So I don't think they are going to do anything for now yet.
Yeah. Just to follow up on that, how significant are these ongoing talks between the US and China for market sentiment in Asia Pacific region? I mean, expectations are low going to these talks given the complex nature of trade negotiations and the tensions in the relations between, the world's number one and number two economy. But still, would such symbolic diplomacy bode well for investors, or do you think they're going to look past that and want something more?
It is quite an interesting way to look at that. I think investors are now trying to scramble to every little piece of news that surrounds any trade talks or even just bilateral talks between US and China. For one, they want more certainty of their portfolio, especially of onshore, offshore Chinese equities, whether it will see a better roads ahead and into 2026. So that's one. And that's why they are scrambling to look at any piece of news between US and China. The second part, where it will be a signaling effect. Now, the trade talks between US and China will also be signaling what the other countries could be seeing in the days ahead between themselves and the US. So I would say that the trade talks right now that we are seeing between US and China will be setting the path or the lead of future negotiations between countries and the US, particularly larger emerging market countries.
All right, Francis, appreciate your time. Francis Tan, the Chief Strategist Asia, Indus West Wealth Management.